All right, good morning, everyone. Let me introduce myself. My name is John Paul, DayTradeToWin.com. Please do me a favor, and if you could let me know if you can hear me loud and clear, and if you can see my chart as well. Hey, Walter. Good morning, everyone. Fantastic. So let's begin with some general disclaimers, getting them out of the way. Please remember that everything we're going to do here when it comes to trading is risky. So please do not trade with funds you can't afford to lose. Please talk to your licensed broker. If you have questions, trading is not for everyone. So be very cautious. And that's actually why I prefer everyone when they join either one of the programs or the mentorship classes to practice first, ask lots of questions, understand the risk. I go a lot into risk, and before you take your first trade, understand everything that's involved. Hey, Mark. Good morning. All right. Anyone have any questions for me before we begin today? I am recording this, and it's important to ask questions. Usually after these webinars, I do get a lot of questions about what was presented, and I invite you to ask questions because everything that I do, I try to be mechanical, I try to be objective, and that's the way I think it should be. So when I look at what's coming up here in May, we've had very slow volatility, and like a cycle, I expect the market to increase in volatility. It could be based off of anything. So when you look at the market and you say, I want 1 point of target, or I want 2 points of risk, or I'm looking for a big home run trade, sure, all those things are possible. But let's take it an additional step. The markets are typically very volatile at certain points of the year and very slow at different points of the year. So what I want you to focus on are groupings of days or groupings of, let's say, hours, and almost like a cycle. Not that I teach cycles, that's not the primary motivation for trading, but I do have to understand that if we're in a cycle of slower environment or slower period, that eventually, if I'm using certain values, like everyone likes to optimize their values, moving averages and things like that, eventually it's going to change. And when it changes, you have to be prepared for it. So I think the best thing to do is be adaptive to the current conditions and realize where we're at. The market opens right now, and for me, living in the Eastern Standard Time Zone, now Eastern Standard Daylight Savings Time, and I can expect a lot of volatility. It's normal. But as we go forward into the day, the market typically slows down. Now, this is absolutely normal. And how do I know that? Because if you take a look at the overnight, you can see that the market is typically slower. So if I take a look, let me just remove some things here. If I take a look at the market here, you can see that the volatility increases within the first 2.5 hours of the day. Again, absolutely normal. And if you look at overnight, the market is also slow, absolutely normal, unless there's a reason for it to continue or to change. So if you hear of news, if something happens around the world with the current environment, then you're going to see, as far as a change of being very slow, you're going to see the volatility increase dramatically. So you have to be prepared for it. My goal is to trade when the market is normal, not when it's too slow and not when it's over volatile. So if you ever come into a situation, it's most likely going to occur sooner rather than later, where something happens in the world. When you see the market reach roughly 5 points on the ATR average true range, and just to give you a little bit of background, if you're a new trader, I like price action. I don't like to add indicators to my chart. The ATR, which is the average true range, I'm using a setting of 4, really looking at the last 4 completed candles, last 4 completed days, last 4 completed hours, for example. And that tells me what I can expect into the immediate future. So if you ever come into a realization that the market is too volatile, you need to know that it may not be worth trading because of the risk. The risk is very strong or very high at that moment. So I'm going to put a line here just at 5 points, which is about 20 ticks on the E-mini. And that tells me that if the market begins to trade around this area or higher, to stay away, because the risk is so high to get stopped out and to lose money with smaller losses. The same thing when the market's too slow. As you know from the hundreds of videos that I have out there, I recommend never to trade when the market is too slow because there's a lot of chop and flip-flop. And the example would be if you take a look at this area right here or this here. This is hours on end of being very slow and choppy. Really, I can't expect anything more than a tick or two out of each signal. Again, it's a risk that's unnecessary to be taken. And the same thing when it's too volatile, it's a risk unnecessary that you should be taking. So really, I'm looking for the market to be normal, above 1 point, below 5 points. And I think those are the best areas to trade. Now, in addition, because the market's slow, you have to look at when do these opportunities exist. They always exist within the first few hours of the day, specifically, I think 2.5 hours of any session. So when you look at the first 2.5 hours of any session, any market, there's a little bit of variance there because some markets don't trade as many hours as the E-mini S&P, but if we're looking at the financials, I'd say the first 2.5 hours are the best. And you could see it because here, as soon as the bell rings, the volatility increases and you have a lot of opportunities. And the same thing after hours, it's too slow to trade, you have a lot of chop. And here we are now at a live chart, and you can see as soon as the bell rings and everyone begins to buy and sell in robots and manipulation starts to occur, the volatility increases. So within the first 2.5 hours are typically the best. I do get a lot of questions on, can I trade in the afternoon? I have a job, I can't trade in the morning. Those are all great questions. As long as the ATR is above 1 or 4 ticks, you can have an opportunity to trade. But really the best time is to trade in the early hours of the session and try to stay away from the last half hour because there's a squeeze on day traders. A lot of traders are on margin, and if they have to exit before this session ends or before the pit session ends or the day ends, they're forced out. And so there's a little bit more of a manipulated move based on short squeezing or squeezing of the day traders out of the market. And so you have to be aware of that, not to trade right into the close of the session. So what I'm going to show you today is the at the open method with the software ATO2 for NinjaTrader 8. And the method is an idea that as soon as the market begins to trade and begins to actually have higher volatility due to the bell ringing, due to the initial push that everybody brings to the market when it opens, I may have an opportunity. Now that being said, still we have to look at stops, we have to protect ourselves, we have to understand the risks. All those rules should be mechanical and objective. So when I look at the first few trades of the day, they are typically the Atlas line, which is a proprietary system, and the at the open method, also proprietary. And I like to have a class with everyone who purchases the ATO or the Atlas line, a live class so I can actually go over the software, go over the method, make sure you're doing it right, and that you understand the rules to use it correctly. So when I look at here, I'm going to add the at the open here and the Atlas line. I'll show you both. I'm looking at NinjaTrader 8 here. The software is now coded for NinjaTrader 8. It's been updated, and those of you who have lifetime licenses obviously get free updates and upgrades. So I'm going to add here first the Atlas line, and here's the back end of the Atlas line. It's pretty straightforward with market open time for you in your time zone, the sound files, and then we have these additional signals, pullback and strength trades, bounce trades, and so on. And so all this is covered during the live training. I'm going to apply it here to the chart, and I'm going to look at yesterday just to give you an example of some opportunities. So yesterday, the first trade of the day on the Atlas line was a short, as you can see here. Now this short 23.8275, the one thing you have to focus on is whether or not there's any type of significant news event that's about to be released. Typically, you can look at the Bloomberg economic report. You can look at the news indicator that I have coded here for NinjaTrader 7 and NinjaTrader 8. So if I click on the news indicator, you'll be able to see into the future any news right on your chart, and you can actually download this for free on the free software portion of DayTradeToWin.com. And you see here in a live and updated way the indicator giving you when and at what time. So really the focus is on the high priority news events. So when you look at this short trade 23.8275, we could see after the fact how far the market moved to the downside. And that is really deceiving, because looking at this, you could say, I would have done this, I could have done this, or I should have done this. But it's not really the way trading should be. If you look at the actual signal and when it occurred, you already have to have a type of stop, how I'm going to manage this trade, what's the target. Everything really has to be, in effect, prepared so there's no issues. So when I look at this here, and I'm going short at 23.8275, the current conditions, the only thing that I could tell you from what is happening at the moment is a trade for about 5 to 6 ticks based on what the current conditions are telling me. I don't know that all this is going to happen. Nobody knows. I can just tell you that based on the ATR, this is what I can expect, which in turn tells me what my stop should be. This is an exact target. What's overbought, oversold? How do I manage this trade? So you can't look at a chart that's already fully plotted and say, I could have done this, or this is what I can expect. It's really based on the current conditions at the moment. So a 1.5, that's what I could expect, and the market made the 1.5 very easily. Now you can trail a stop. Things that I teach, like trailing stops, absolutely not a problem. But the initial stop and the initial target have to be based on the current conditions at the time you enter into the market, not after the fact. And the same thing here with this pullback trade that's occurring. When I look at this pullback, see the P's up there, they're indicating pullback, or these P's here indicating pullback. When I look at that, I can see after the fact what happened, but at the moment the trade actually fired off and said, this is where you need to go short right here based off of this pullback pattern, I'm going to say the ATR is above 1, the market's normal. What's my risk? My risk should be relatively small because it's a small target on this pullback trade. And if everything according to the rules lines up, great, I'm short. And the good thing about it is there's not any moving averages, there's no momentum, there's no bands, there's no really anything to clutter your judgment about what's happening here. So if I'm going short, I would love to say to everyone, expect to see that, but we don't really know all this is going to happen. So you have to take into consideration what you know at the time of the trade to make the decision to take it or not take it. Questions for me, anyone? All right, Dwayne, let me know if you're okay. Walter, Glenn, everybody else. The same thing with this strength trade. If you want to take this strength trade here to go short, obviously it's already an Atlas line short trade. It's not as if you have to double up and take this strength trade as well. And again, the current conditions say market's volatile enough to trade, about a 1.5 on the ATR. What's my stop? What's my target? And away it went. So be careful not to just assume the market's going to make 5 points or 10 points on any one trade. It may, but just look at the current conditions. If it's slow, expect a slower or smaller target and stop. If the market's more volatile, you may not want to trade, or you have to increase your target in order to compensate for the larger stop. Now, large stops are terrible. Nobody likes the large stops. I get a lot of emails on risk-reward ratio. And you have to look at this as a whole. If you decide to go, for example, right here, right now, short, let's say, you know the current conditions are a point and a half. And your risk, you say to yourself, I only want to risk 1 point. Well, if you risk just 1 point, it's possible that the market, because these are the current conditions, that the market could go up or down against you by a point and a half. So if your stop is smaller than the current conditions, just the random movement of the market going up and down and up and down, up and down and up and down, equal to this value can stop you out unnecessarily. I'm trying to avoid that with what I call a catastrophic stop, a stop that's larger than the current conditions. Keeping me in the trade is important, but also knowing when to exit and get out is also important. So in addition to what I would consider the catastrophic stop, in case everything goes wrong, it protects you, there are other ways to get out of the trade. So some of the ways that I teach are time. If you're in a trade, the market's not doing anything, going anywhere, then why am I still in the trade? There's no reason for me to take a trade here to go short, and then 3 hours later the market's here and nothing's happening. I don't think that's worth the time and the risk. If this doesn't immediately qualify and make your target, then there's no reason to stay in the trade. So typically, when I look at the Atlas line, when I look at the ATO, I like to hold trades at a maximum of 4 candles, in this case 20 minutes, and you're done. So 4 candles after you enter, which is time-based stop, you're out of the trade. You don't have to worry about hope that it's eventually going to go in your favor. Sometimes it's a small win, sometimes it's a small loss, could be break even, but you're really managing the trade not just with a price, but also you're managing the trade with a variety of exit strategies, whichever happens first. So the catastrophic stop is there to protect you if everything goes wrong. The time-based stop is there to protect you in case you're in the trade for the 4 candles or 20 minutes and nothing is really coming out of it, you're out of the trade. And then you also have what I call proof, or maybe even the pivotal stop, depends on the actual signal. And the proof is basically saying there's proof here that the market's not going in my favor. It's not going down. It's not going up. Why am I going to hold on to something that has proven to me that it's not working? So I recommend exiting the trade, and if you have some type of proof, to get out of the signal that you're in, because there's no reason to hold on to it. So when I think of trade management, I also think of my 3 or 4 stops. Whatever happens first, I take. The catastrophic stop, believe me, it's not the one that we should be waiting for and taking. It's there as the manner of last resort. So the stops that I use are a little bit larger than the current conditions. It's basically meant to keep you in the trade, and if it doesn't work out, your target's not met, the time-based stop or the proof or the pivotal stop will get you out of the signal. All right, so that's how I like to manage trades, not just a one hard price stop. I also like to look at, hey Mark, good morning. Same way, Mark, on ATR and gold, same exact way. Nothing changes with the setting of 4. You just have to look at the ATR and you have to understand what it's telling you. Some markets work in ticks, some markets work in pips and cents, so it depends on the actual scale of the ATR. In the US financials, they're in points. In the currencies, they're in ticks. So when I look at, for example, the current chart right here, I see the market going down and down and down. A lot of traders, when they use the typical moving averages, the typical MACDs, those are indicators that if you look back in history and you optimize them, they look great, right? You can actually get a perfect number on any of these indicator crossings and they work fantastic. But moving into the future, they very rarely work. And I'm also a true believer of actually showing you and teaching you what you're doing, as opposed to a room where you're just following a narrator and you're trying to understand why the entry is long or short. You'll never learn. The goal is to be independent. The goal is not to be locked into a room where you're just following like a herd of sheep what the moderator is calling out, because you'll never understand it moving forward. You'll just say, I'm always waiting for the calls or the software to be provided to me, and I don't know why I'm entering long or short or why I'm getting out of the trade. So when I see this here market going lower and lower and lower and lower, many of you may look at this as a trend to the downside and it's time to get in, right? Time to jump in and time to go short. I actually have a different thought on this. I think that you can go short if the evidence says you can go short, whether it's the ATO, whether it's the Atlas line, whether it's the roadmap. But you can't just assume that because you have all these candles telling you to go short, that this is the time to go short. As a matter of fact, I would actually say to you, the market is poised to reverse and turn around and go up. Now, the reason why I know this is because markets are manipulated, and they're manipulated in such a way that I can almost tell where the right place to go short or long is based on how the bigger institutions manage their money. So take, for example, right now, I mentioned to you that the market was going to go up and reverse. It's not to say that it's going to make a huge reversal. It's just to say for right now, there's profit taking occurring, which the little guy, you and me and everybody else who deciding to sell and sell and sell, how many contracts do you think that we're selling? 5, 10, 1, 2? And then think about an outside influence, an outside source saying, take profit and buy 100, 100, 100. So what you're seeing, this manipulation that I teach, is based off of profit taking at areas that are predetermined, and if they are actually happening, why would I go short just because the moving average says to go short, or just because the momentum or the MACD is telling me to go short? I would rather wait, give it a moment, to make sure that I'm not going into a position short, for example, against this powerful organization which is going to stop all the little guys from going short. Now, typically, it's short-lived. So if what you're seeing here pauses the market for a little bit, it doesn't mean the market's not going down eventually. It may, but for the moment, there's no real reason for me to, for the moment, right? There's no real reason for me to fight all of the power that's stopping the market behind what you're seeing. So what that means is that if you have some type of trade signaling at an area where this manipulation happens, you're going against the bigger players and you're going to get run over. So my goal as a teacher and as a trader, risk is very important. There's no reason for me to try to go and risk a trade when I know it may not happen. So I'm filtering out signals based on manipulation. Now, can I also take a signal or a trade to help me go long? Absolutely. Why not? If I know that this is where it's going to happen, then why can't I also take advantage of it? So it's twofold. It's first filtering out signals and trades at areas where you've already learned and understand that this is going to happen. And it has nothing to do, by the way, with previous support or resistance. So if I look back, a lot of you may think, and I think it's a good idea to look to see if there's some type of major support or resistance that happened in history, but there's nothing here. I'll just crunch up the chart here a little bit more. There's nothing here that I could say definitively that the market would stop there. So this is actually a very unique way to look at the market, nothing complicated. You don't need a scientific calculator. And I actually want you to learn and understand the hows and the whys behind what you're doing. Not just because I said don't go short and listen to me and follow me. There's a reason that you need to understand behind this. Now, after the market stalls here, it could very well turn around and go up. It could clear all of these profit takers that are buying the market and get them out of the way. And now, if it's time to go short, fantastic. It's time to go short as the market continues on a new journey. But for right now, there's no reason for me to go short against the bigger players. Does that make sense to everyone? Anyone have any questions for me? A few things here. The market is best traded within the first few hours as everybody jumps in and makes the moves occur. That's the first thing. The second thing is, if you don't understand the risk involved, ask yourself, what type of risk am I jumping into? Because if I do go short, is there something stopping me from going short? This is actually a great example. What am I looking at here as far as managing the trade? So this Atlas line short here at 23.8250, I'm suggesting to you to wait until it's proven going short can still happen, but you got to be careful because there's manipulation here happening at this area. When I talk about the stops and I talk about overbought, oversold, these are rules that are not subjective. For example, the prove it stop. When I look at this signal here to go short at 23.8250, the good thing about this short signal is the risk. If this market comes up and decides to continue higher here, and I'm short this Atlas line signal, the prove it stop, the rule for the prove it stop would be any candle closing on the opposite side of the Atlas line. So look how close this is actually occurring. This signal happens right under the Atlas line. If this candle closes where it is, a few ticks higher, you're immediately out of the trade because you have proof it's not going in your favor. So the prove it stop is there to protect you with a smaller loss. 4 candles into the future, which is about 20 minutes. If this has not made a profit, you're out of the trade, win, lose, or draw. So again, another hard and fast rule objective to manage the trade. In addition, let's say that the market goes crazy and it just goes straight up. Right? I said to you that I expected the market to stop here because of proper profit taking, and it'll go straight up. Obviously, if the market goes straight up and it goes against you, you have to protect yourself. You have to have some type of loss or stop there in order to get you out of the pain. You have the catastrophic stop there as the last resort, which I really don't want, but it has to be taken. So don't hold on to trades unnecessarily. If you hit any of these stops, whether it's a break-even trade or small win or small loss, get out of the trade. It's very simple. It doesn't have to be complicated. In addition, if I look at the target, current conditions tell me 7 ticks. 7 ticks from 23.8250 would be, I'll just put this right here. Right here. So I don't know the future. We're not looking at a chart that has already plotted. This isn't market replay. This is a live chart. Current conditions are 7 ticks. If you go short, that's really all I can expect. Even for the people who have not heard me speak about front running and first come, first serve, these are terms that you have to understand what they mean in electronic trading. First come, first serve. Excuse me. First come, first serve is based off how the markets work. When you take a look at moving your, let me just bring up here a dome and I'll show you. When you look at moving your orders around here, so let's say that you go short here and you say, you know what, I'm going to take a profit here. And then you change your mind and you move the profit target again. And then you say, you know what, I'm going to put it at break even. And you move the target again. And then you move the target 3 or 4 times while you're in this trade short. Every time you move your target or you move the limit order, more importantly, you're placed at the back of the line. So we don't want that. If you're going to have a stop, you're going to have a target, you absolutely want to be in a situation where your target is there or your entry into the market is there and you don't move it until it's absolutely necessary. So when I look at this here and I say it's time to get out of the trade, it's just close, or I move my target right to where it's trading, or I move my stop to right where it's trading. But try to keep your limit orders, either entries or targets, in place, because you're always placed at the back of the line. It's happened to everyone where you place an order and it touches and it touches and it touches and it touches, but you don't get filled. That's because there may be a lot of people in front of you. It's a ticket system. You get in, you place a ticket, and if the ticket doesn't get filled, or if you move it and you're at the back of the line, you're never going to get filled. So the first come, first serve is all about that. Front running is a little different. Front running is when I say, I want to take a trade, but because the market is slow, I want to ensure that I get filled. So I mentioned to you that the target is 2381, which is 7 ticks. Front running basically means placing your target 1 tick in front of everybody else. Now, front running is a very bad way to explain this, because a lot of people get in trouble for front running trades with insider information. We don't have insider information. We are just placing our target not at the exact current condition. We're placing it a tick in front of. So instead of it being 7 ticks, it may be 6 ticks. So you're ensuring that once it goes through your price, then you're out of the trade. You don't have to wait for it to actually come up to your number and fill you. So front running and first come, first serve are important things to understand when trading electronically. In addition, a lot of people try to read tape. And so when you look at these values, for example, 1024 at 2386, you may say to yourself, there's no way that all of these numbers are going to be absorbed to the upside. I have to say that the numbers that you're seeing here are completely fake. They're not real. If it was 30 or 40 years ago and you're reading a tape, it may be different. But as we are now electronically, it's so easy to take on and take off and take on and take off and change the number of contracts that you are actually looking at numbers that have no relationship to contracts that want to be filled. So I would not recommend trying to interpret, trying to look at this and say, I understand that the market won't be able to break through all of these people trying to get filled, because these are not real contracts with real people trying to get filled. They could be robots, they could be automated systems, but it's very easy to take on and take off any amount of contracts at any time. So don't trust these numbers. That's what it comes down to. You can't look at these numbers and really understand that they're meaningful in any way. All right, any questions for me? So front running, it's a good idea, especially when the market's slow. First come, first serve. First come, first serve is a ticket system with electronic markets. Don't move your limit orders around. Stop orders convert into a market order. So you really can't say a stop order helps you. You're still going to get a tick of slippage. A tick of slippage is the smallest increment being a tick. You can have a tick of slippage with a stop order, because stop converts to a market. So a stop order is just like using a market order at a specific price. A stop with a limit, although, is you're limiting the amount of slippage. So you can have a stop with a limit, no slippage. You can have a stop with a limit, 1 tick of slippage or 2 ticks of slippage. It's up to you. And that's the middle mouse button here in NinjaTrader that initiates the stop or the stop with limit. And left click is the entries for limit orders. And by the way, if anyone needs NinjaTrader, please contact us. We can provide you and help you accessing and downloading NinjaTrader 8. That includes live data, so you can practice with a live market, and it's helpful. You just don't jump into it without practicing and understanding the software. You should get accustomed to it. Now I'm going to add here, if you'd like more information on how to start day trading, please visit DayTradeToWin.com. You can also download the Getting Started guide. And remember, trading is risky, please do not trade with funds you cannot afford to lose, whether it's stocks, options, futures, or Forex.